everybody hear me okay? Great. Thank you so much. Thanks for the kind introduction. Thank you to the president and all the organizers for putting this together. I think this is an extremely important time to get together and have an event like this and kind of discuss what's going on and what we can do about the future, which is ultimately in our control. And I think it's important to remember that. I mean, just being here in India, I wish everybody in the trade globally could come here and just see the scale and the size of the industry here and how many people are directly impacted by this industry, and all those people have families. So when you look at the amount of people impacted and affected by this industry, I think it really puts in perspective and hits home how important the future is. And I guess I would just start off just to remind everybody, I mean, it is difficult right now, and I think it's easy to be pessimistic, but the reality is this is still, close to an $80 billion global industry. And over the long, run, if we're looking at, 10, 20, 30 years, we still do have growth. And I think there's opportunity for growth in the future that's going to correlate with, global population growth and growth in middle class and overall growth in wealth. So I do think there is, a lot to be optimistic about when we're looking, especially longer term. So with that, so my background's as a financial analyst, and I operate now as an independent analyst and consultant, specifically working within the diamond industry. So my job is basically to take in as much information as possible, to process, analyze the information, and then kind of come to some sort of conclusion what all that information means and what it can mean for the future. So that's what I'm going to try to do for you today. I'm just going to start off by just kind of giving you an idea of the sort of things that I'm looking at right now. So these are kind of near-term catalysts, and then from there I'm going to just go down into supply, demand, diamond prices, and kind of give you an idea of what I see within each segment of the industry and try to come to some sort of conclusion or idea of what that can mean for the future. So this is what I'm looking at right now. I mean, at the end of the day, demand is the most important thing in this industry. Demand drives all segments of the supply chain. It drives all segments' profitability. When demand is good, working this industry is easy. And demand is definitely the biggest challenge right now. It's across markets. So I can just say as an American, the economy in the U.S. is probably better than I think everybody expected. We actually did not have a recession coming out of the pandemic. Growth has slowed. Consumer spending in general has slowed a little bit. But in general, people are still working. And as long as people are working, they will continue to spend money on discretionary items like diamonds. I think the U.S. market will probably be down a low single-digit % this year. But I think when we look, over the last 5 years, the demand for diamonds in the U.S. is still above those pre-pandemic levels. And the U.S. represents over half of global diamond jewelry demand. So it is the most important market from that statistical standpoint, at least. China is very concerning. China, over the last 20 years has grown to the industry's second largest market. Would it be possible to get some water? My throat's getting a little bit sore. China's been kind of the big growth driver for the industry, and demand for diamonds in China has essentially fallen off a cliff the last couple of years, and I think we're all feeling it. And to me, that's the most important thing happening right now. Thank you very much. I think we need a recovery in China if we want, to get back to any resemblance of, what the industry was like, 3-4 years ago. As the president, briefly alluded to, China is doing things to stimulate their consumer economy and just overall consumer sentiment. And based on my understanding, is the problem in China right now is more of a sentiment issue. I think consumers were kind of psychologically damaged from the extent of the lockdowns, and I think there's concern that they need to save money and not spend money because there could be situations in the future where people are kind of kept from working. So I think it's more of a sentiment issue. I think, by and large, that's probably something that, we can work through, and it's going to, take some time. But I do think there will be recovery in China, and I don't think, the Chinese are going to allow their, economy to collapse or anything like that. But I think we're definitely going through a structural slowdown in China. But I do think we will see a recovery in China eventually. Looking at supply, so supply is the one thing that we as an industry have the most direct control over. I mean, we saw, especially the Indian midstream come together last year and reduce supply to market. I think that was definitely the right thing to do. I think we did see, an immediate response, in price support following that. And then I think when the supply opened back up earlier this year, that's when we started to see, decline in prices again. So there's definitely a direct correlation there. And the one thing I would note is that I think this industry is very unique in kind of coming together and working together in ways to support the industry in challenging times. And I think, I think that's something this industry could be proud of. I can't think of any other industry that, is successful working together in that way. And I think, again, putting an event like this together today is another example of the support of the industry. And there's, very resilient people in this industry. And I think when we look at the long-term, success of this industry, it's been a very resilient industry for a very long time. And I think that's because of the people. And I think, working together to reduce supply to market is the most important thing that we could do right now. And I do think we're going to start to see, the benefit of that, in the coming months and quarters. Lab grown, I think everybody's getting, sick of talking about it at this point. I think it's playing out as most expected. It's a manufactured product. Prices are coming down. As the price comes down, I think it's considered, it's being considered by consumers as a different product, given the significant difference in price point. So much of this is going to come down to marketing and how the natural diamond industry markets its product. And that's something that's on the natural diamond industry. They have to do their part to convince consumer to pay a big premium for a natural diamond over a lab diamond, and we can't forget that. Lastly, sanctions. This was obviously a big topic of conversation, a year, 2 years ago. It's kind of taken a back seat at this point. I would say it's more of an inconvenience, if that's the right word for the trade at this point. It's not really having a significant impact on supply. I think, when we see, inventories normalize and, if and when we see a recovery in demand, that's when you're going to start to feel the impact of the sanctions. But the trade really hasn't, felt the impact from a supply standpoint. It's just been more kind of internal inconvenience at this point. So with that introduction, I'm going to go into supply in more detail. So from a supply standpoint, the industry is in pretty good shape. And a lot of this has to do with the natural dynamics of the way that supply works. For a mining company, the amount of supply that they, produce is going to be directly correlated with their profits. And as the price of diamonds goes up, assuming that their costs remain relatively fixed, they're going to try to ramp up production as much as possible. In a downturn, when prices are soft and operations uneconomic, you'll see, mines put on care and maintenance. You'll see supply reduced. You'll see operations curtailed. And that's what we're going through right now in the short, medium, and longer term. So we have a very clear downtrend in supply. And I think, that's something that is, a favorable fundamental factor to keep in mind. To put this in context, there's literally one mine in the world of significant scale that's going to be put into production this decade. It's the Luale mine in Angola. Outside of that, there's no other major source of production, and a lot of the older legacy mines are running out of production, or they're running out of the years of their economic lives, and this is ultimately why we're seeing a decline in supply. Just quickly on lab grown, again, it's a manufactured product. The producers do well when they ramp up capacity and improve their economies of scale. Basically, the more they produce, the lower their per unit cost. So the producers are incentivized to continue to ramp up production, and that's why we've seen lab diamond supply just explode. It's all about capacity expansion. And the other side of that is, the more supply we have, the lower prices are going. So, that trend is very clearly intact, and I think that's something we're going to continue to see. If you look at the other manufactured gemstones, the supply, far exceeds that of the natural equivalent. I would, be pretty confident predicting, in 10, 20 years' time, the amount of, lab diamond produced is going to be multiples more than natural. I think that's inevitable. So this is a visual interpretation of natural diamond supply. And this is kind of giving you some context going back to the early 2000s. So, we had, in the, let's say the last 20 years, the high watermark for production was almost 175 million carats. For context, this year we're going to be at a little bit over 100 million carats. So we're talking, there's been a significant curtailment of natural diamond supply. And again, you have to remember this is correlated to price. So if diamond prices go higher, more capacity will become economic, more capacity will come online, and you will see more supply. But diamond prices have been relatively flat for the last 10, 15 years. Operating costs have increased with inflation. And mine economics for the miners have, they've been squeezed. And because of that, there's less production. There's less production online, and there's less money being spent on future sources of supply. And again, so the key takeaway here is, so this year so De Beers cut production guidance twice this year. They basically cut production guidance 10% and then another 10%. And when you factor that in, which is kind of the low point on this chart, which is where the blue shaded area reaches the unshaded area, that's where we are today. To give you context, this is the lowest natural diamond supply has been since 1996. And that was before there was Canadian production, and that was before there was large-scale production in Angola. So I think you gotta kind of look, at it, from that context. Supply is down significantly. These are just a few other charts, just some factors I like to look at. So the left is just natural diamond production by nation. Russia, Botswana remain the major producers. Canada's number 3, but the 3 major mines in Canada are approaching the end of their lives. By the end of this decade, production's either going to be basically closed off at most of these mines, or it's going to be curtailed as mining methods are employed that yield less output. Angola is number 4, but they will become number 3 in the coming years with the introduction of that new mine that's coming online. Namibia production is going to remain relatively flat. That's mostly the subsea ocean production. That is a profitable operation, and the resource of that operation is actually quite significant. So I would imagine Namibian production is going to remain relatively stable. South Africa, basically the only mine of significance is the Venetia mine, which just was brought underground. And that mine, we can expect production to remain relatively consistent for the next 15 to 20 years as well. The next chart here, I'm just looking at open pit or underground, which is kind of the more commercial, the high capex production methods. That represents the bulk, almost 3/4 of global production. Then we have alluvial, which is basically mining that's soft rock. You don't need explosives to break the hard rock. That's represents maybe 15 to 20% of global supply, and then the light gray is artisanal. So that's just independent, non-commercial mining. Most of that comes from the Congo, and I would note that Congolese production has dropped significantly in recent years. They used to produce 20 million carats of low-quality goods. We're probably looking at maybe 10 million carats. So there's been a significant drop in production, even in that segment of the market. Production by quality. We have 40% gem, 40% industrial. The balance is near gem. When the market's good, those near gem goods will be sold as jewelry. When market's bad, they'll be sold as industrial diamonds. I would just note from an economic standpoint, for the mining companies, they make all their money with the gem goods. The industrial is just strictly a byproduct. And then just by sales channel. So contract is going to be the De Beers sites. It's going to be Angolan production right now, and it's going to be Rio Tinto with what's left of the Diavik production. And then we have Russia, which I put in a separate category. Post-sanctions, the way they're selling is a little bit different now. And then the light gray is just auction, tender, and offtake. And offtake is basically when a private investor makes an investment in a mine and they get access to all the production. So the structure of the industry is changing in this sense. Botswana government's going to get a bigger share of the De Beers supply going forward. And they said they're going to use some sort of mix between auction market and contract market. So by and large, the contract selling segment of this industry is going to decline going forward, and more goods are going to be sold by tender and auction, which is going to reflect near-term or short-term market fundamentals more, and it's going to result in more volatility in prices. And just a few more thoughts on production here. So again, I mean, these are just, this first bullet point, just a few examples of diamond mines that are relatively large mines that are reaching the end of their lives. So we're going to have 20 million carats come off from these legacy mines listed here over the next 10 years. It's approximately 15 to 20% of global supply. And again, this is just a trend of these old large mines reaching depletion, and there's no source of new supply to offset the mines that are closing. From a, say a De Beers standpoint, I mean, at this point, they're just going to continue to expand their largest, most economic mines. Zhoneng comes to mind. They have to take Zhoneng underground in the coming years. It's going to be a multi-billion-dollar project. So, even these legacy mines that historically have been extremely economic still need significant amount of capital to keep them running. And the price volatility that we're seeing right now, certainly makes the decisions that they have to make more difficult. And I would just give you an example of, if we look at the Gauchakwe mine in Canada, it's a joint venture between De Beers and independent producer Mountain Province Diamonds. They were exploring taking that mine underground once it reaches depletion in the coming years, and they halted that project based on current price fundamentals. So that's just another example of prices definitely having an impact on medium and longer term supply. And what I outlined here mines that I think are going to be in production in like the 2040s and 2050s. So this is when we're looking like really far out, and the question becomes, are we going to run out of natural diamonds? Will we have enough natural diamonds to keep the product relevant to mainstream consumers? And basically what we have is we have a small handful of mines that are historically have been highly economic. They have huge resources, very consistent production, and I call this like a core. This is like the industry's core production. It's like these mines here. So you could see, most of these have, at least 2 or 3 more decades of production. And when we go out to 2050, these mines alone still are going to account for, say, 60 million carats. And again, this is if we don't account for any future, new supply. So we definitely have, this core production that's going to take, the industry into the 2040s and 2050s. On the midstream, this is your guys' level of expertise. I don't have a whole lot to say here. As an analyst, I'd like to look at midstream inventory and kind of use that as kind of a short-term indicator for where prices are going to be. Again, I think the midstream should be applauded for being proactive and trying to restrict supply when we have an oversupplied market. That does directly impact prices. I think we're seeing it today. Just looking at the data that I have on polished, it seems like polished prices are finally starting to stabilize for the first time this year. But it's been an extremely difficult stretch, and polished prices have been under pressure, and obviously that's impacting all of your profit margins. The one thing I would note is that I think most of the midstream that was that has taken an inventory hit as inventory has been marked down. I think maybe on a relative basis, the good news is going forward, we've reached like a lower level of price, and I think that allows relative profitability going forward, because I think the base of supply that the midstream holds now is at a much lower price point than it was 2 or 3 years ago. So I think that from a fundamental analysis standpoint at least, I think it's going to allow for a return to profitability because the inventory that's being purchased now is being purchased at a much lower price. So I think that's just something that the trade has to work through. And just to kind of give you like an example here, so you know, I have a polished price index, and it was literally down 14 weeks in a row through the end of July. I mean, so it's been brutal, and I can understand from a manufacturer standpoint why it's hard to continue to buy rough when polish just continues to go down. But again, I think once we get support in polish prices, I think that's going to improve sentiment, and that's going to hopefully slowly allow the trade to get back to a level of profitability. And I think once that happens, sentiment will start to improve, and people will be, you know, more comfortable buying supply again. And this is a chart of my calculation of inventory held by the midstream. This is basically gross, so it includes, you know, goods that are being processed. This isn't just excess inventory. This is total inventory. And I would just look at this as like a relative metric. Don't get too concerned with the dollar valuation, how I calculate that. But the point being is if we look at the demand peak and say, you know, May 2020, that's kind of the low point in inventory. And then obviously we had the demand slowdown, which was the high point in inventory, you know, in let's say, you know, May 2023. And I think a healthy level of inventory is somewhere in between that, you know, that peak and that trough. And I think we're slowly starting to work back to that level now. I do think we're going to start to reach, you know, a relatively healthy level of equilibrium in inventory levels, you know, at the current pace of, you know, supply curtailing. And I think we'll hopefully start to see that, you know, sometime next year. Hopefully it's in the first half of the year. From a Q&A standpoint, do we want to wait until the end to do questions, or do we want to take questions as we go, or? Okay, sounds good. All right, so I mean, looking at demand here, you know, the big takeaways there's just been tremendous volatility. I mean, the pandemic resulted in an extremely unusual situation for the industry. I don't think anybody's seen anything like that before, where we went from the global economy was locked down, sales basically stopped, to, you know, $7 trillion of economic stimulus in the developed markets, which just, you know, led to this huge surge in demand for hard luxury and diamonds in particular, as people, you know, couldn't spend money traveling or going out to eat and that sort of thing. So it was a you know, highly unusual, you know, and highly volatile period for the trade. You know, I think when you just kind of take a step back and look at where we are today, so, you know, for instance, say like Signet Jewelers, it's the largest diamond seller in the world. They're the largest diamond seller in the US. It's a public company. They're pretty transparent. And, you know, just kind of direct your attention. So in 2019, they did $6.1 billion in sales. This year, they're going to do about $6.9 billion. So, I mean, we're still, you know, over 10% above where we were pre-pandemic. And, you know, this year, their guiding sales are going to be down, you know, a low to mid-single-digit percent. Sales were down a mid-single-digit percent last year. So at least in nominal terms, you know, diamond sales are still growing. I think it's a good proxy for the U.S. market. I mean, the U.S. is now over 50%. It's probably, you know, 53, 54% of the market. So the industry remains, you know, significantly sensitive to demand for diamonds in the U.S., and that's going to continue for the foreseeable future, you know, especially as China is in the situation that it is. You know, just kind of getting into some kind of more nuanced things that I'm looking at. So the jewelers in the U.S., you know, say it's still definitely a highly promotional environment. They basically bought too much inventory coming out of the boom years of 2022 and 2023. They have too much inventory, and they're trying to liquidate that inventory and improve their own cash positions, and that's resulting in, you know, discounting. I mean, they're discounting diamonds. You know, in this industry, it's a luxury product. We don't ever want to discount. I mean, Louis Vuitton, Hermes, they never discount their products. And I think, you know, as a trade, when we do discount diamonds, it has you know, certainly has a negative, you know, impact on consumer sentiment. We're seeing that in China right now, where they're definitely prioritizing gold over diamonds. And part of that is just because the industry got, you know, caught in a situation where it had too much inventory and it started, you know, discounting diamonds. and it definitely has damaged the sentiment of diamonds as a store of value and as a a highly valuable product. That said, the U.S. I think has been doing a pretty good job of working through inventory. I'm sure all the manufacturers here have experienced that firsthand, that inventory buying is down. Companies are holding less inventory than they've held in the past because they got stung in the last few years. That said, I think once confidence returns, in the U.S. retail market, I think you're going to start to see them kind of build back inventory levels that maybe they've had more historically. But they're hesitant to buy until they see stability in prices. So again, so much of this is about confidence and sentiment. And I think once we finally start to see polished prices at least stop going down and hopefully go up a little bit, that's, I think, where you're going to see demand for inventory purchasing in the U.S. to start to return. And I think we're just finally starting to get to that point now. I think if we're looking at, so if you look at the third bullet point here, just, say we look at engagement ring budgets. So historically, an engagement ring budget in the US would be like $6,000. Based on, the work I've done on this, it's probably closer to $4,500 or $5,000 now. So we've had like a 20% deflation in the amount that consumers in the US are willing to spend on an engagement ring. And that's something everybody in the trade should be very, very concerned about. And again, a lot of that has to do, with just a decline in consumer sentiment and, diamonds being discounted and promoted in the last couple of years. And then obviously the other big factor is lab-grown diamonds. So, I mean, if people are buying a lab-grown diamond in lieu of a natural diamond, they're, probably going to be buying it at a lower price point. So you're basically giving consumers, permission to spend less on an engagement ring. And that's something this industry historically has done a very good job of maintaining the perception of how much consumers have to spend for an engagement ring. And obviously De Beers was kind of the backbone behind that. That's something that's definitely changed in the last few years. So I think that's an area that the industry really has to focus on, is try to get, again, the perception of diamonds kind of back to a healthy place, and get consumers to spend more for say something like an engagement ring purchase. I think this is already kind of said today briefly, but India is the only bright spot in the industry. I think technically speaking, India is actually larger than China right now. China's fallen so much. India is definitely gonna be the large growth market for diamond demand. I was just at the mall across the street, and it's apparent. I think it's apparent how important India is going to be for the high-end luxury market in the years to come. And you talk to the watchmakers, you talk to the luxury conglomerates, and they're all very enthusiastic about India. But it's going to take some time, where I think India is going to grow to a big enough size where it's going to be able to offset what's been lost in China. Right now, in the near term, we need a recovery in China. India is not going to be big enough or growing fast enough to just offset everything that's been lost in China. And then just looking at demand in general. So, and just looking at like macroeconomics, my background's as a financial analyst, so I pay attention to global economics and what's going on in the global economy. And what ultimately drives growth, which we measure, as gross domestic product, GDP, it's basically, it's population growth. The easiest way to grow an economy is to have a growing population. And as long as we have growing global population, we have a growing middle class, these are going to be positive, drivers for diamond demand. Longer term, this is the trend that we've had. In the developed markets, we have population decline in places like Japan. I would say most of Western Europe. The U.S. would be in population decline if it wasn't for immigration. So I mean, these are the sort of things that I like to look at as an indication when I'm trying to forecast what the future for diamond demand is. But as long as we have global population growth, and we continue to have middle class wealth growth, I'm still confident in the future of that the consumer segment that's going to be buying diamonds in the medium and longer term. as far as marriage rates, so if we look at like marriage rates are falling on a per capita basis. So less people are getting married, but again, we're having global population growth. So the actual gross number of people getting married is still growing. So I think you have to pay attention to all these nuances. And then I guess just my last comment on demand is marketing. The longer and the more I think about this industry, I think marketing is the most important thing. Diamonds are a luxury product. You have to create desire for diamonds. People don't need diamonds; they want diamonds because in the past the industry has done a very good job of promoting diamonds. And right now the industry is structurally different. The De Beers monopoly was dismantled 25 years ago, and I think the industry has been struggling to find its footing to kind of recreate the system that it had in place in the heyday. And we have the Natural Diamond Council, and we've made some steps in the right direction, but I think we just can't continue to rely on the demand and the perception of diamonds that was created during the A Diamond Is Forever campaign. It's wearing off, it's finally wearing off, and there's a new generation of consumers that don't perceive diamonds the same way. So, I mean, we have to continue to spend money marketing diamonds, especially now with the competition from lab-grown diamonds. You have to convince consumers to pay a significant premium for a natural diamond, and the only way you could really do that is with marketing. And I think the industry is at risk of losing a new generation of consumers if we don't effectively do that. Again, there are some encouraging signs, but I would argue that the global marketing spend on natural diamond is significantly below where it needs to be. To maybe put that in context for you, during A Diamond Is Forever, De Beers was probably spending $450 million a year in inflation-adjusted terms. So if we're looking at like $24, today, I mean, we're probably spending under 100 million. So we're spending, say, 20% of what we used to. And we just can't continue to expect the success that we've had in the past when there just isn't enough being spent on marketing. I mean, the obvious challenge with this is everybody wants somebody else to pay for the marketing. Historically, that's been De Beers, but De Beers is structurally different now. And they lost money last year. They're probably going to lose money this year. The parent company has the company up for sale, so I don't think they're too committed to the longer-term state of diamonds. So I think as an industry, you got to kind of come together and come to some sort of solution. How are we going to keep diamonds relevant in consumers' minds, especially appealing to younger consumers, which just don't perceive diamonds the same way that previous generations have. I think the good news here is it's something that's in our control. I think diamonds are a product where you can literally throw money at the problem. I think if we had, somewhere $300-400 million, we had some budget that was similar to what we used to have in the heyday, we would absolutely see a situation that was more similar to what we've come accustomed to in the past. And just as an analyst, that's the one thing that would really get me, enthusiastic about the future of this industry, is if, a marketing, strategy that was sufficient and successfully executed was happening. That's the single most important factor, from my standpoint as an analyst. I talk to investors. I mean, my job is basically, talking to investors that know nothing about the industry, that want to make some sort of investment in the supply chain. And at the end of the day, I say, it comes down to driving demand for the product. And it's a luxury product, and you have to convince consumers to want it. They don't need it. It's not a practical purchase. It's an emotional purchase. And the only way to succeed with that is to market the product and create desire for the product. So I think I've made it pretty clear with where I stand on that. Just a couple other points on demand here. I think we kind of covered China and India. I think when we look at so the Chinese market was definitely growing at a high single-digit, low double-digit rate for almost the last 20 years. If we're just looking at diamond demand, I think India is going to be at that level or higher now. But I think combined, depending on what happens with China, we could see a situation where those two markets, combined outpace the U.S. There's a lot of a lot of variables that are gonna lead to that. But I think we're just looking at, size of population and growth of middle class and consumers that have consumers that are in a situation where they could afford a product like a diamond. It's going to continue to be China and India are going to be the big drivers of growth. So that really hasn't changed that much, despite how much China's fallen off in the near term. Just I think I hit on all these. The last point, I don't know if anybody saw the research that Signet did, that engagements are going to recover in the coming years. And so they basically said during the pandemic, people were locked in, they weren't meeting each other, therefore people weren't dating, and people weren't basically building relationships that lead to marriage. And they're saying that once the economy and lockdowns were lifted, people started dating again, and it's going to take 3 years for them to get to the point where they start getting married. And if you kind of do the math on that and extrapolate it out, it means that you're going to start to see an uptick or normalization in marriages this year, 2025, and 2026. I think they did a good bit of research on this. I think they do have something here. I don't think it's going to be a super acute impact we're going to see in a given month or a given quarter or a given year. But I think in general, I think it's fair to say that there will be a tailwind in diamond demand, just because people are going to start getting married and engaged again. And again, I think that's it's difficult to kind of pin it down with precision exactly when it's going to happen or how big it's going to be. But I think it's, in general, I would call it a tailwind that the industry is going to have on its back the next 2-3 years. So that is maybe something to be somewhat optimistic about. So basically, this is a chart that I compiled. So this is Chow Tai Fook net new store openings. So Chow Tai Fook, the largest jeweler in China, they primarily sell gold, but they are probably the biggest seller of gem set diamond jewelry as well. And this is just a proxy for the size of the luxury market and the jewelry market in China. So these are net new store openings. So you can see, go back to 2011, they had 1,300 stores. Today they have 7,500 stores. But you can see the rate of new store openings went absolutely parabolic the last 4 or 5 years. And this is the first year that they actually have net closed stores, over the last 15 years. So I think this kind of puts in perspective where they are. Basically, these new store openings were like in tier 3, tier 4, tier 5 cities. It was basically catering to first generation of consumers that were buying luxury and diamonds. But again, I like to look at this as a proxy for the Chinese market. And just again, it's still very gold centric in Asia if we're looking at jewelry demand. But one thing you want to keep in mind is that for a jeweler, selling a piece of gem set jewelry offers a higher profit margin than a piece of gold jewelry for them. So they are incentivized to try to sell gem set jewelry and sell more diamonds. Chow Tai Fook has publicly come out and said they're going to try to push the selling of more diamond gem set jewelry in the future because of the profit margin benefit. So that's just kind of something else to keep in mind. You could argue that they have their work cut out for them because there definitely has been a decline in consumer sentiment towards diamonds in the last little while. But I think when we kind of take a step back and look longer term, I don't think China's a lost market for the industry. I still think China has a potential for a lot of good years ahead if the trade plays its cards right. Okay, so we basically looked at supply and demand. So what does this mean for prices? Obviously prices surged. We had based on my rough diamond price index, at least we had diamond prices making a new all-time high in 2022. That basically took out the previous high of 2011. The surge in 2011 was basically coming out of the global financial crisis. There was significant supply curtailment, but at the same time, De Beers was heavily marketing in China. So you had this surge of demand in China, you had supply was restricted, and it pushed diamond prices to an all-time high in 2011. And we saw something, somewhat similar coming out of COVID. So we had significant supply curtailment because of the pandemic, and then we had, $7-8 trillion of consumer stimulus in the developed markets, and that led to a surge in demand, and that's why we saw prices spike in 2022. As things have reversed, people that got stimulus, as that ran out in 2023 and 2024, we had the trade was kind of restocking and replenishing all the inventory they stole in 2021 and 2022. That left us with way too much inventory. Now we have, just an economic slowdown. We've had, again, consumer consumption in China has basically fallen off a cliff in diamonds. So the trade's left with too much inventory. That's why we have that's why prices have been soft. And then we have, obviously the lab-grown diamond factor is another variable here as well. By category, it's, I would say smaller natural goods have been outperforming. I think that's because the high jewelers, Tiffany, Cartier, Van Cleef, Bulgari, they sell jewelry that's like more ornate, more design-oriented. It uses more smaller, higher quality goods. And these are also companies that are still only dealing in natural diamonds. So the brightest segment of the industry has been smaller, higher quality goods, and I think that's being driven by the high-end jewelers and the high-end watchmakers. So this is my rough diamond price index. To give you some context here, this is going back to the pre-global financial crisis, and I think it kind of tracks what I was describing. Coming out of the GFC, we had significant supply curtailment, and then we had the Chinese demand surge, kind of drove prices up. Then we basically had a decade of just flat prices, and then we had the COVID volatility. And now if you kind of look at where we are, we kind of maybe overshot a little bit, but we're kind of at that pre-COVID price level, even though it feels a lot worse. That's kind of where we are when you look at the actual data. Just getting back to to supply here. So this is, if you're a diamond miner, this is basically the prices that you're dealing with. And we had record inflation the last, or at least generationally record inflation across most of the developed world the last few years. And this has impacted the mining companies. Everything from tires to explosives to labor has just skyrocketed, and diamond prices are flat to down. So they've been squeezed, and that's why you're continuing to see supply come off. So again, I mean, there's basically a natural hedge in place. When prices come down, supply comes down because of that built-in dynamic. When prices go up, typically supply goes back up because it's more economic to mine. And just to kind of put this in perspective, from my background as a mining analyst, if you just have you have a small residential property and you have just a backyard, you technically probably have gold in your backyard. It's probably very, very tiny, little tiny pieces of gold, but theoretically there is a price point where if gold got high enough, it actually would make sense to mine your backyard. So the point being is, I mean, that's an extreme example, but the point being is mining dynamics are very, very highly correlated to to price. And if the price gets high enough, projects that in the past weren't economic will become economic. So that's kind of the dynamic to think here. And again, we've had diamond prices that have been flat to down, and that's why supply is coming down. If diamond prices were up, we would have supply growing, because there are undeveloped diamond mines that would be economic at a certain price point. Just looking at prices going forward. I mean, again, it's very difficult in the near term given the volatility across the board. I think what we need to happen is we need polish prices to stop going down. I think once polish goes down, I think the trade is going to start to see a return to some more, if not positive, just less negative sentiment. And I think you're going to start to see confidence returning. And the way this trade works is when prices go up, people buy, and when prices go down, they don't want to buy. So it's kind of counterintuitive. You see it in the stock market as well. So it's just, I guess, human psychology. But I think once we start to see support in polish, and I think we're going to see support in polish because so much upstream supply has come offline. So I think if we get to a point we see support, maybe we see some small growth in prices, and then hopefully profitability will return to the midstream, and then confidence will start to pick up, and we'll start to see maybe retailers maybe see the value of their inventory start to improve a little bit, and maybe they'll get confident to kind of replenish their inventory. So there really is a sentimental and a psychological component to this. But I talk to retailers, and they don't want to buy as long as they think the prices are going to continue to go down. It's like they aren't going to buy, they aren't going to inventory. We need prices to stabilize. Just looking at my own data, I would just say over the last 5-6 weeks, I've actually started to see polish stabilize a little bit, which is encouraging. And again, I think that's a direct reflection of the amount of supply that's coming offline upstream. I think when we're looking at natural diamond prices longer term, I would call like the wild card is what's going to be the longer term impact of lab grown on natural. To me, that's going to come down to marketing again. How good does the natural diamond industry do marketing its product and convincing consumers to spend 5, 6, 7 times more for a natural diamond over a lab diamond? And something else encouraging. There's so much to be concerned about, but there are some positive things happening. De Beers struck a promotion cooperation with Signet, Chow Tai Fook, and Titan. So they basically went to the largest diamond seller in each of the industry's 3 largest markets, and they have an arrangement now where De Beers is basically coming in and trying to train the frontline salespeople, in these companies of how to sell a natural diamond. And that's very similar to what De Beers was doing during the Diamond is Forever era, where it was called, I think, like the Diamond Promotion Council or something like that, where they would actually, part of a Diamond is Forever campaign was coming into individual jewelry stores and actually training the staff how to properly sell a natural diamond. And I think that's definitely the sort of thing the industry should be doing. I wish they could scale this up even more. Just something else on that. I talked to wholesalers in the U.S., some of the biggest wholesalers, and they say they go into an independent jewelry store in the U.S. and they say that they'll have a small independent will have 8 salespeople, and they'll say 4 of the 8 salespeople have literally never sold a natural diamond. I think it kind of puts in a perspective of how much the industry has changed, and how much the natural industry has fallen behind, where you have, say, a new generation of salespeople that literally haven't sold a natural diamond because lab diamonds have been the preferred choice of the retailer over the last 3 or 4 years. And just a little bit more on this. So, with lab grown, obviously there's going to be some overlap. It's also going to result in some incremental demand for diamond sales. I think as the price goes lower, you're going to be selling lab grown to customers that otherwise, wouldn't be able to afford to, or wouldn't have bought a natural diamond anyway. And that's what I would classify as incremental demand. I think you're seeing that at places like say Pandora, selling lab grown diamonds. Their average price point at Pandora of selling a piece of jewelry was maybe $75. That's their average ticket sale. So that company's catering to consumers that are not spending hundreds or thousands of dollars on jewelry. They're spending sub $100 on jewelry. So I think if somebody's buying a diamond from Pandora, that's in general, it's probably a customer that probably wouldn't be buying a natural diamond. So that's a situation where a lab diamond sale isn't necessarily hurting the natural industry. It actually just may be introducing a new consumer to the diamond category. So that's the way that I try to look at this. I have to, kind of look at this in a very objective, balanced way. I try to not get emotional or pick a side, when I'm analyzing this. But again, I like to break this down, between natural diamond sales, lab diamond sales that are taking sales away from natural, and then just lab diamond sales that are just incremental to the industry. So that's kind of the way I break it down. The next chart is a reflection of that. Lab-grown diamond production is going to continue to explode. It's going to be multiples greater than natural diamond production. It's just, again, a question of who's it going to be sold to and what price point. To give you some context here, so if we're looking at synthetic diamond produced for industrial applications, so say like abrasive, cutting tools, construction equipment, the Chinese produce 12 billion carats a year of that. 12 billion with a B. Natural diamond production is going to be 110 million carats this year. So that just shows you, with a manufactured product, what the capacity could be. It doesn't mean there's going to be 12 billion carats of jewelry quality diamond produced at some point in the future, but they could if they want to. And this is just a lab diamond supply chart. I mean, it's just up and to the right. It's going to continue to be up and to the right. It obviously really started to take off, in those pandemic years. I just listed what I saw, some catalysts. Lightbox, I think, was a catalyst. Pandora selling lab-grown. Kieran, obviously a big player getting in the lab-grown game as well. Just some additional lab-grown diamond data. So it's basically, it's a market. It's basically China and India. At this point, I think there's multiple, Indian lab-grown diamond producers that have capacity that's in excess of 1 million carats a year. That would have been unthinkable, 5, 6, 7 years ago. The industry has changed so much. Again, for a lab diamond producer, it's all about capacity. The more they produce, the less their per unit cost. It's an economy of scale business. They're incentivized to continue to ramp up production. The Chinese, again, they still have a tremendous amount of capacity. They're typically producing via HPHT. However, there's some, very good Chinese producers in the CVD space as well. Just looking at this first chart, so I actually am estimating that India is a larger producer of lab diamonds for use in jewelry than the Chinese at this point. Historically, the Chinese have been the big producer, but that just shows you how much, production in India has increased. I would, argue that the Indians have a competitive advantage because they tend to be vertically integrated companies. So, that they're benefiting from the synergy of being vertically integrated. Obviously most of them are producing the lab grown, they're manufacturing the lab grown. They have the wholesale and the distribution, the D2C businesses already set up from their, from their experience working with natural. So I think they're kind of naturally positioned well, to vertically integrate. The US basically has one producer, it's the Diamond Foundry. It's really hard to figure out what's going on there, but the company says that they're gonna be a producer of millions of carats of lab grown. It's hard to verify that, but for the time being, they've raised a significant amount of money, and they have been expanding production. So that company by itself is a significant producer. Again, CVD, HPHT, that's the breakdown I estimate. And then, perhaps most importantly, I mean, this is where, the demand is being driven by the US. The US is over 3/4 of demand for lab-grown diamond jewelry. And it's amazing how the one market has basically, driven, the explosion in lab-grown. This is just a table I set up to kind of give you an idea. These are just what I would consider like more prominent or just jewelers of interest, whether they sell lab-grown diamond, and if they do sell lab-grown, whether they sell it as bridal. So it kind of looks the way you think it would. I mean, you look at a company like Signet. Historically, they've sold man-made ruby, emerald, sapphire. They sell moissanite. They sell CZ. In addition to natural. So I think companies that historically have sold other manufactured gemstones, it's a natural progression for them to sell lab diamonds, and I think we've seen that. Obviously Tiffany, Bulgari, Cartier, not selling lab-grown diamonds. They've been very clear. They say their customers want rare and valuable materials in their jewelry. And I guess just getting back to the first point I made on lab-grown, so it's not a zero-sum game. So basically what I'm saying is that just because a lab-grown diamond is sold doesn't mean that a natural diamond was not sold. It just means that it could be incremental or it could be overlapping with natural. And I think the next chart I have is a portrayal of that. And just maybe one final comment on lab-grown here. I think we're running a little bit over time. So the low-hanging fruit, the easy money in lab-grown was basically just to produce a generic, colorless diamond, sell it as an engagement ring diamond, and say it's the same thing as a natural diamond, but it's a lot cheaper. So you're essentially dumb to buy a natural diamond. That's kind of been their strategy. I think it's going to get more difficult to do that going forward as the competition and supply is kind of hurting prices. I think the price delta is getting so wide that consumers are going to be asking more questions. So I think for the lab diamond companies are going to have to actually take the more challenging approach, which is doing something to differentiate their product, whether it's a different color, whether it's producing and cutting a different shape, or producing a new piece of jewelry in totality that is different from what else is on the market. And I think most of the future success in lab grown is selling it in those ways. And I would also argue that when lab diamond's sold in those ways, it's less competitive with natural diamond. And this is just basically my total demand. I have a model where I try to model where diamond demand is going to be, and this is just going out to 2027 as an example here. So basically, the light gray bar is natural diamond demand. This is in jewelry, so this is complete natural diamond jewelry at the end consumer level. So on the left column, that's in billions of dollars. So the light gray is just natural. The light blue is man-made diamond that's sold that otherwise would have been a natural diamond sale. And then the lightest blue on the top segment there, that is man-made diamond that's I consider incremental to the industry. That's lab diamond being sold to a customer that otherwise wouldn't be buying a natural diamond. And the way I analyze this is I'm basically trying to forecast the price of lab diamonds and how much the price of lab diamond versus natural is going to influence the consumer's decision. This is my lab-grown diamond polish price index. It's composed of the most popular sizes of lab-grown. I mean, as you can see, it's down and to the right. It's basically a linear decline. And again, this is because it's a manufactured product. And this is just actual data. This is retail sales data of lab-grown, generic lab-grown diamond versus generic natural diamond. This is a 1 carat. So again, lab-grown down and to the right, natural diamond price has been hit as well, given the factors that we discussed today. And this is a 3 carat. I mean, we're at the point now where the customers that are buying lab-grown, they only want 2, 3, 4 carat. They aren't really buying 1 carat or anything smaller at this point. So I think this is the one that's kind of the most pertinent. But again, the price points are extremely different. A 3 carat natural, medium quality, still selling for $50,000. At retail, you can buy a 3 carat lab grown for $3,000. So I don't think a customer's walking into a jewelry store with a budget of $50,000 is going to walk out with a $3,000 diamond. So I guess that's kind of my final thought on that. It's my disclaimer. If anybody has any questions, let me know. And these are just some of the products I offer and my contact information. If anybody wants to reach out, I'd like to hear from you. And if anybody wants a copy of the slides, I'll email those to you. So please, reach out. That's my contact information there.
Thank you, Paul.
Thank you.
A big round of applause for Paul. I had a few questions, but I think I'll first throw it open to the audience, and then I'll, if there's time, I'll come back to some of my questions. Any questions, please? Please just raise your hand. We'll get some mics across to you. Anaga, can you get some mics across? Yes, Sriram. Can you get some mics, please? One mic here.
Paul, hi, good morning. This is Gunjan Jain. I wanted to understand, in your Signet sales, you said we are 10% higher than 2019 levels. If I see metal, which is a composite part, I believe, of these sales, this is not only diamonds, this is jewelry as a totality. So gold in 2019 was 350. Today we are at 2,700. Silver was $20. Today we are at $31. So technically, if I put that in account, we might be down by 15 to 20%. It's not maybe 10% higher. Is that correct? Or is how we are showing is correct?
Yeah, no, I think you're thinking about it the right way. They don't break down specific sales by category, but Signet's still a good proxy. Half their sales are diamond. The bulk of those sales are bridal. So as far as like large, publicly traded, transparent companies, I still think it's kind of the best proxy to keep an eye on. They have a quarterly analyst call. They will kind of go into detail and answer questions that are more specific. But I would argue that, on a relative basis, probably, non-diamond jewelry has outperformed over the last few years. And again, that's going to be, like you alluded to, it's going to be a function of, metal prices going up, just labor prices going up. A complete piece of jewelry is going to be more than it was, 5 years ago, just because the labor associated with that's higher, the transportation, the distribution of that's higher. These are definitely all factors, to keep an eye on. But, at the end of the day, that's, what their sales are is a reflection of what consumers are willing to spend on jewelry. So, the diamond trade could win more of that share. Again, I think that's up to the diamond trade and how good of a job it does, marketing its product and convincing a consumer to buy a piece of natural diamond jewelry over a piece of created, sapphire, created diamond, or just a gold piece of jewelry. So, that's the consumer spend that's available to the industry, and I think Signet's again just kind of a good proxy for that.
I think the part which you missed was Signet also now sells a significant chunk of lab grown. So even if the diamond, everything is the same, we still lost a big chunk there. Right. Sriram, you had a question?
Yes, I do. Paul, that was a great presentation. Thank you. The question that I have is with reference once again to lab grown. A few years back, we saw a lot of the independents in the US shifting from natural to lab grown, or beginning to carry lab grown as well. Now, with the recent dramatic price reduction, I'm keen to understand how that's changing. Along with that, I'm also keen to understand how engagement ring buying is changing with such a dramatic drop in the price of lab grown. Thank you.
I'll probably make it a little bit more direct. He was Sriram is very kind, okay? With the price dropping, retailers of lab grown are facing a challenge of their top line, right? If my price is $100 per carat of buying a 1 carat stone, even if I sell it for $300-400, it's still a big challenge if I have to send 10 of those to meet my natural piece. What is the retailer's reaction in the US to this?
Right, so I'm actually glad we brought this up because this is an extremely important point here. So if we just look at why did lab grown take off in the US, the reason it took off because jewelers were incentivized to sell it. At the end of the day, the jeweler they aren't loyal to natural, they aren't loyal to lab grown, they're loyal to making money, right? They want to make money, and the lab grown offered a better way to make money, and that's why they sold it. And I think as soon as they get to the point where they're more incentivized to sell a natural diamond from a profitability standpoint, they will go back to natural. So, if the natural diamond industry can come up with a way to make it more profitable for retailers to sell natural over lab grown, they will go back to selling natural. And I think that's the best way to think about it. To me, it's very consistent. You talk to retailers, why are you selling lab grown? They say because it's more profitable. I think it really is that simple. And that's where lab grown went out because they were basically able to sell it at a relative percent of a natural diamond and not sell it as I think we were talking last night, a cost plus. It should be cost plus. They aren't selling it as cost plus. I think if they do start selling it at cost plus, it's going to be more difficult.
Do you see any retailer saying, I'm going to get out of lab grown? Yet?
Slowly. Not as much as I would have hoped. But again, at the end of the day, if selling lab grown becomes less and less profitable for them, they're going to hopefully go back to selling natural diamonds. I think that's what got us in this situation. So I think that's what's going to get us out of it. Is if you're a jeweler, you have to sell $7,000 and $8,000 jewelry to make a living. You can't make a living selling $300 jewelry. And I think that that's ultimately where this is going to go. But it doesn't mean that the natural industry could just kind of sit back. We have to convince consumers to pay 5, 6, 7, 8 times more for a natural diamond. And if they could do that, they're going to continue to succeed. And I think it's in their interest to do that.
We probably need to convince the retailer that they have to convince the customer.
Right.
We had a question there.
Yep. Hi, Paul. This is Nitin from RT Group. Just want to have a little more clarity on China market, very important market for us. A customer of mine spent about $3 million in China last year, got 0 sales or very minimal. And he spent $1 million in Japan, and the same $1 million got him good sales, and that was also from Chinese in Japan. So just want to understand what's happening in China. Is that something to do with the government, which is restricting the buying, or people have lost a love for the diamonds? Just want to understand this. Thank you.
We can have a whole session on China. I would just suggest, because there are a few other questions, just keep it a little brief, please.
Okay, so just to hit the top points here. So in my opinion, as an analyst that tracks global economies, what happened in China was they extended the lockdown to the point where people in China were afraid that the government is going to restrict them from working in the future. And if that happens, they feel they have to have a lot of savings, right, for another situation like that. And they're basically afraid to spend money on things they don't need, like jewelry and other discretionary items. That's what's going on. And now what compounded that problem is natural diamond prices are going down and gold prices are going up. So they're saying if I am going to buy a piece of jewelry that I don't need, at least if it's gold, it's going to retain its value and maybe go up. If I buy a diamond at current trends, it's going down. So there's a kind of a micro and a macro problem there. I think the micro problem, again, is kind of the confidence in diamond as a store of value. That's up to the industry to convince a consumer that diamonds are rare and valuable and that they do have a store of value component to them. And it's just difficult to do that given that gold's at all-time highs right now and diamonds are down 30% in 2 years. So the consumers in China are smart, and I feel like more so than, say, the US market where they really pay attention to what's going on. So those are the two main components there.
Thank you, Paul.
Hello, sir. My name is Surendra Dasani. And just you saw that after 2015, every year lab-grown diamond used in jewelry is just doubled. Means double every year from 2015. And secondly, that natural diamond prices at present are compared to 2010, I think almost as 2008, 9, 10, big sizes, I'm talking about big sizes, had come down from 2024, now it is just like as 2010. How you think how the natural diamond business will survive? Then the prices have come down to 2010, 2009, 3 carat, 4 carat, 5 carat pieces. It is very difficult to satisfy our customer. Now the customer is coming to buy more diamond natural, then he is just asking, the price is just like 2010. So how you will, we should do to, how to popularize this natural diamond. Second, still you are thinking the natural diamond prices can go more down in next 2-3 years.
Can you relay some of that?
So, a couple of questions. One is prices are back down to 2008, 7, 8, 9, 10 levels. So how can the industry survive? And so that's, and how do you convince the customer to buy the?
Right. So I think depending on the category, prices are going to be, they're down significant. My index is not down to those lows of 2008.
That's the rough index.
The rough index. Certain polished categories are. No, again, it's a problem for the whole trade. I mean, that's why you're seeing mining supply come off. It's not profitable for a lot of the miners to produce at the less economic mines. Again, I think supply coming in is kind of a natural hedge. As supply comes in, it balances the market out. Hopefully that, theoretically in fundamental terms should be supportive of prices. But I mean, right now it's just leading to industry contraction. I mean, that's just the reality. The only way I think industry can overcome this is to drive demand with marketing. I mean, it just seems very clear. I mean, if you just go back and look at the history of this industry, it was built on marketing. That's the only reason diamonds are what they are. I mean, The only reason that diamond is as special as it is and as mainstream as it is on a global basis is because of the success of the history of the marketing. And the industry lost its way. I mean, there was no generic marketing from 2005 to 2015. Then they created the Natural Diamond Council. And again, the budget there is probably $50 million. I mean, and De Beers used to spend $450 million. So I mean, I don't think anybody should be that surprised by this. I mean, when you just actually look at the figures.
Yeah. Thanks, Paul. I'll just give you one more question. You know, the industry, even before the COVID hit in 2019, it was still in a gross dollar terms smaller than or equal to the 2008 or before 2008 industry size. So we've not really grown. So it's not that the challenge is only with lab grown. If you ask me, the biggest challenge is maybe something like an iPhone. You know, people don't want to buy jewelry. That is the bigger challenge. And to add perspective to that, the total advertising budget of the iPhone or the Apple is much more than the total size of our industry. Nirupaben, you had a question.
I want to understand, is there any exploration activity going on all around? Because even if there is some exploration today, it takes maybe 10, 15 years for the mine to commence production. From what we saw, you only mentioned the Angola mine, Luel, which will come on stream with 4 or 5 million carats.
I think it's all.
Are we seeing that there is no in foreseeable future, we are not going to see any natural diamond mine coming up?
Yeah, it's a good question. Thanks for that. So if we just look at just pure exploration spend on diamond projects, it's probably 10% of what it was 10 years ago. So it's down 75, 80, 90%. And again, that's a function of diamond prices. And I mean, most of the easiest, you know, most successful diamond mines have already been mined out. The easy money has been made. So all the future deposits have some sort of complication, and that's why they haven't been put into production yet. So they need a higher price to make the economics work. So that's the most important way to look at that. So if prices go higher, you will see exploration increase. And you're right, even if a discovery is made, it could take 10, 15 years to bring it online. What's going to happen before a new mine coming online is one of the existing mines that's been suspended, put on care and maintenance, will be brought back online. That's easier to turn a mine that's suspended back on if prices recover, and that's where the bulk of supply would come from.
So Paul, let me ask you a hypothetical question. If in a year's time, prices are up by 50%,
Yep.
Rough prices, how much more supply would come on stream?
So we would
That's
go.
just to give people a perspective
Yeah.
that we are talking about 100, 120 million carats is the production. If prices go up 50% or they go up double, you know, how much more production do you think will come out?
So if prices double next week, I think supply would go from, it's 105 million carats this year. I think it would go to like 135, 140 million carats that quickly.
Are there really that many mines out there?
There are mines
in
that
care
are.
and maintenance? Because
It's not even that, it's just capacity. I mean, even De Beers' most profitable mines are only producing at a, you know, I don't know, probably 70, 80% of capacity. Same with the Russians. They can bring on more capacity if it makes sense. They could lower the recovery. So the other thing they do is when the market gets bad is they basically only recover the big diamonds. They don't spend the money and the time to recover the small diamonds. So they could basically run, you know, the processing plant at a finer level and recover more diamonds that way as well. So there's a lot of different ways to do it.
One last question, probably on everyone's mind. What do you think will happen to De Beers?
Well, thanks for asking the easy questions. So there's nothing else like De Beers. I mean, it's complicated because it's vertically integrated. So it's a mining business, it's a retail business, it's a wholesale distribution business, it's a marketing. I mean, it's everything. So there's not a whole lot of buyers that are up for that task. I think even, you know, Johan Rupert of Richmond has said, he's like, I like the business, but I don't know how to run a mining business. So I'm not going to buy it. I mean, he was very clear. You know, the mining companies, the major mining companies have basically all come out and said they aren't interested in buying it. Their investors want, they want materials that are going to be used in the green infrastructure revolution. They want copper. They want, you know, the battery metals. They don't want to deal with diamonds. It's too different, and they look at it as a distraction, you know, from their core business strategy. So I think the most likely outcome would be some sort of consortium. Maybe a group of players from the supply chain coming together. They're probably going to have to work with the government of Botswana. I think the government of Botswana wants to be involved with whoever the new buyer is. But again, that's just a whole other layer of complexity, is that the joint ventures that De Beers has with Botswana, with Namibia, it's just a very complicated business structure. If De Beers was just to spin it out and say, we'll make it a new company and Anglo-American shareholders are going to get a share of the new company, the problem there is they're going to probably have to raise capital. So, I mean, De Beers is in a situation where they need, a few $1 billion to bring Zhuaning underground, and they just have, other, OpEx requirements, and their sales are going to be down, 20% this year, and their sales were down 20% last year. De Beers is probably not going to cash flow this year. So they basically need like a cash reserve for future investment and just to kind of get them through the current market lull. So if they just to spin out the company, they still could, potentially have a capital challenge. So it's a difficult situation.
Yeah. One last question, Mehul Bhai.
Thank you, Paul. It was an excellent presentation. So one of your slides says that the inventory is of 50 billion. So this 50 billion lasts for how many days? I mean, what is the global sales of diamonds? So we can consider that we have the inventory of such a period. That is one question. And one reply, what everybody is looking for the answer. I am sure nobody has a perfect answer because we are not God. Where the prices of the polished diamonds, natural diamonds will go. Whether this is the bottom, whether it will go further down, and now it is high time that it will recover.
Right. Another easy question. So from an inventory standpoint, I can share that chart with you if you want. We can talk about it later. So I think the lowest inventory is going to be the level we were at in early 2022. So because we've had such unusual volatility the last 4 years, you can kind of see the peak and the trough of where inventory is kind of max and minimal. So the inventory levels are going to be somewhere in between there. So theoretically, I think inventory can come in, $5 billion, $10 billion, and kind of still be, within that sweet spot. And then on polished sales, again, I keep coming back to the same thing. I think it's going to be a function of, China recovering. It's going to be a function of how does the industry do from a marketing standpoint, competing with lab diamonds. Are retailers going to switch back to selling and prioritizing natural because it's in their, financial interest to do so. So, it's multivariate. I mean, we all know that, and it's kind of keeping track of all those variables and how they're progressing, and that's, something that I try to do. So I'm happy to kind of keep you up if you ever have any questions on any of that.
Thank you, Paul. As I like to say, rough is from Mars and polished is from Venus, but we are part of the same solar system.
There you go.
Thank you, Paul. Can I?
Thank you very much, Pranay. Thank you, Paul.
Yeah.
It was indeed enlightening. A big hand, ladies and gentlemen, for Paul as well as Pranay. And we request you to stay on the stage, please. Well, we would like to remind you, Paul, that we have a power session with the De Beers group here with Mrs. Nirupa Bhatt post-lunch. Thanks, Pranay. I would now request Ramnik Bhai as well as Mr. Milan Parekh to come on stage and felicitate Mr. Paul Zimnisky with a memento. Thank you very much. Can we have the memento, please? Paul, please. Mr. Pranay Narvekar, can you join us on the stage, please? Thank you very much, ladies and gentlemen. Over to you, Pranay, for the next session. Thank you.